You may have heard of the term DeFi if you follow the world of NFTs, blockchain, or cryptocurrency. It is short for decentralized finance, and it could be the future of the financial system. Hello and welcome back to the Finance Guardian channel. DeFi is still somewhat new and has a Wild West feel. It is like the early days of the internet that resemble the basic chat rooms, rudimentary websites, and early online service providers. As blockchain networks, decentralized exchanges, and DeFi protocols become more common, crypto enthusiasts claim the future is bright. But do they really create the future of finance? In this video, we will look closely at what DeFi is. Hit that subscribe button and the bell beside it, and let's get started. What is DeFi? The term DeFi is short for decentralized finance. The name was originally coined in a Telegram group chat in 2018. Software developers brainstormed the name for an envisioned network of financial services built on blockchains, cutting out the intermediaries typically involved in facilitating the transactions. Basically, DeFi is an umbrella term for financial services on public blockchains. By using DeFi, you can earn interest, borrow, lend, buy insurance, trade derivatives, trade assets, and more without the paperwork of banks or other third parties. As with crypto, the DeFi setting is generally global, peer-to-peer, pseudonymous, and open to all. What does DeFi do? Another usual question surrounding the DeFi system is, what does it actually do? Depending on whom you ask, the answer will vary. But it usually boils down to giving individuals more control over their finances and, to a certain extent, the financial system. To put it simply, DeFi is about freedom. You can use the DeFi space to control your assets completely, whether they are cryptocurrencies, fiat-backed stablecoins, etc. It's possible to execute transactions faster than they would in a CeFi or centralized finance system, because blockchain technology acts as a permanent record of transactions and ownership data. However, this freedom and control comes at a cost. One of these is that it has fewer safeguards protecting consumers and their assets. It's truly a Wild West feel, where if assets are stolen by hackers or through other means, they may not be recoverable. How does DeFi work? Smart contracts are the backbone of the DeFi system. Simply put, smart contracts are computer codes. These are basically instructions that tell a software program how to behave. Smart contracts are just codes. They are instructions to run an application. Says Ozer, a leading global expert on blockchain and cryptocurrency. A smart contract reads the request specifics when executing a transaction in the DeFi ecosystem. A series of protocols are followed by those smart contracts to push transactions through the system. In other words, when you press the F key on your computer's keyboard, the computer sends instructions to display the F on your screen. That is how smart contracts work similarly, Ozer says. There are a number of players involved in the CeFi system, which can create some serious delays. For example, whenever a bank executes a transaction, it often works with another bank and an intermediary to transfer funds and instructions. Multiple companies or institutions may be involved in even the most straightforward transaction. In a sense, DeFi smooths all of that out, making things easier, faster, and cheaper, given that everything goes well. How is DeFi being used now? In addition to simple transactions, DeFi is also being used for complex financial transactions. The system relies on decentralized apps called dApps, or other programs called protocols. dApps and protocols process transactions in Bitcoin or BTC and Ethereum or ETH. dApps and protocols are being used in some of the ways on traditional financial transactions. Using DeFi, anything from payments to trading securities on lending and borrowing is already possible. E-wallets. DeFi developers are creating digital wallets that can work independently of the largest crypto exchange and provide investors with access to everything from cryptocurrency to blockchain-based games. Non-fungible tokens or NFTs. NFTs turn things like videos of slam dunks or the first tweet on Twitter into digital assets that can be bought and sold. NFTs make things that couldn't be traded before tradable. Stablecoins. In contrast to cryptocurrencies that are known for being volatile, stablecoins attempt to stabilize their values by tying them to non-cryptocurrencies, such as the US dollar. Decentralized exchanges or DEXs. Coinbase and Gemini are the most popular centralized exchanges right now for cryptocurrency investors. The DEX facilitates peer-to-peer transactions and lets users maintain control over their money. Yield harvesting. Dubbed as the rocket fuel of DeFi and paves the way for speculative investors to lend cryptocurrency and maximize the possible returns on those assets. DeFi's markets measure adoption by measuring locked value. which calculates how much money is flown between different DeFi protocols, and the total locked value for DeFi protocols these days is almost $43 billion. Blockchain's omnipresence fuels DeFi adoption, and the moment a dApp is encoded on the blockchain, it is globally accessible. The majority of centralized financial technologies and instruments develop slowly over time, governed by regional economies, respective rules and regulations. However, dApps operate outside these rules, resulting in more significant rewards and probably greater risks. Bitcoin may be the most popular cryptocurrency, but Ethereum has more flexibility and is adaptable to various uses, which is why most dApp and protocol landscapes use Ethereum-based code. The benefits of DeFi. DeFi has many interesting uses, many of which can't be done with traditional fiat-based financial systems, and its first benefit in this list is that DeFi doesn't need permission and is open to all. DeFi services can be used by anyone with a crypto wallet and an internet connection, no matter where they are. Users can also trade and move their assets wherever they want without waiting for bank transfers or paying standard bank fees. However, there may be other crypto-specific fees that may apply, like gas fees. Second, transactions are made in real time and are completely transparent. When a transaction is completed, the underlying blockchain is updated, and interest rates are updated numerous times every minute. Every Ethereum blockchain transaction, which accounts for over 90% of all DeFi traffic, is broadcast to and verified by other network users. This level of transaction data transparency ensures that any user can view network activity. Third, DeFi data is tamper-resistant, auditable, and secure, thanks to blockchain technology. And lastly, many DeFi protocols are open source. Ethereum and other projects are built with open source code that anyone can monitor, audit, and extend. Developers can easily connect numerous open source DeFi applications to create new financial products and services without permission. The risks and downsides of DeFi. DeFi is a relatively new phenomenon that imposes numerous risks. It has not been stress tested yet through prolonged or widespread use. Besides that, national authorities are scrutinizing the systems being implemented with an eye toward regulation. Other risks associated with DeFi include: Number 1. There are no consumer protections. DeFi managed to thrive without rules and regulations, but this also means that users may not have much they can do if something goes wrong with a transaction. In centralized finance, the Federal Deposit Insurance Corp, FDIC, reimburses deposit account holders up to $250,000 per account per institution in case of bank failure. Also, a certain amount of a bank's capital is required by the law to be held in reserves to ensure stability and to be able to withdraw money whenever needed. DeFi does not provide similar protections. Number 2. Hackers and threats. While a blockchain is nearly impossible to alter, other aspects of DeFi are vulnerable to hacking, resulting in funds thefts or losses. It is important to note that all potential uses for decentralized finance involve software systems that are vulnerable to hackers. Number 3. Collateralization. Collateral is a thing of value that is used to secure a loan. A mortgage, for example, is collateralized by the home you're purchasing. In nearly all DeFi lending transactions, collateral is required to equal 100% of the loan amount or more. As a result, many DeFi loans are only available to specific individuals who meet these requirements. Number 4. Private key requirements. Currency and DeFi require that you secure the wallets you use to store your assets. Wallets are secured by private keys, which are long, unique codes known only to the wallet's owner. Losing a private key means losing access to your funds, and there are no ways to recover it. The future of DeFi. DeFi looks to have a bright future in the digital asset space by eliminating the middleman and creating digital assets with monetary value. DeFi's promise and potential are far-reaching, which is why Dan Zimmerman, head of financial relations at the IOTA Foundation, a research and development organization dedicated to DeFi, sees both as promising and practical, even though it is still in its infancy stage. There will be more independence for investors in the future, which will allow them to deploy assets in creative ways that seem impossible today, Zimmerman says. Also, DeFi has significant implications for the big data sector as it matures to facilitate new ways of commoditizing data, he added. Although DeFi appears to have great potential, its adoption by the general public remains a long way off. So what can you say about DeFi? Let us know in the comments below. We hope you enjoyed this video, and if you did, please hit that like button. If you're new around here, subscribe to our channel to remain updated about all our future videos. We'll see you next time.